Hi, I'm Tom Dalton, and welcome to Tax Boot Camp. This is part 2 of corporate tax formations using Section 351. In this video, we're going to focus on liabilities, so let's get started. If you remember part 1, Section 351 covers the situation where shareholder or shareholders are contributing property to a corporation in exchange for stock in the corporation. In this example, the shareholder is contributing land to the corporation in exchange for stock. The shareholder is also putting in the mortgage to the corporation, so there is some relief of liabilities to the shareholder. In this example, we can estimate the value of the stock in the corporation to be the equity on the balance sheet under fair market value. So the value of the stock we're going to estimate as $100,000. The other thing that the shareholder is getting, though, is the relief of a $20,000 debt that's being transferred to the corporation. If you remember in part 1, the first step in evaluating a property transaction, such as an incorporation, is to calculate the realized gain or loss. In this case, the amount realized is the fair market value of the stock plus the relief of debt for a total of $120,000. From this, we'll subtract the basis of the property that was transferred to the corporation, which is the land, at $10,000. This gives us a realized gain of $110,000. Step 2 in evaluating a property transaction is to determine if the realized gain or loss is recognized. For an incorporation, Section 351 says generally no if it's an exchange that's property for stock and the shareholder is in control immediately after the exchange. In this example, that appears to be the case, so Section 351 should apply. But we also know under Section 351 that no gain or loss is recognized except to the extent that boot is received in the transaction by the shareholder. Boot is anything the shareholder receives in the transaction that is not stock in the corporation. That includes cash, property, and also it includes liabilities that the shareholder transfers to the corporation that exceeds the tax basis of the property that's transferred to the corporation. That's how boot is created from liabilities in most normal situations. That's a situation where the taxpayer doesn't have a sinister motive, or another way of saying it is a tax avoidance motive, for transferring liabilities to the corporation. If, however, the IRS determines that the taxpayer did have a tax avoidance motive, a sinister motive, for transferring liabilities to the corporation, then it can assert that all the liabilities are to be considered as boot in the transfer. Take a close look at the example we showed a minute ago. Notice that the liabilities are $20,000 that were transferred to the corporation. Then notice that the basis of the property transferred to the corporation, the land, is only $10,000. The liabilities transferred are in excess of the basis of the land by $10,000. This creates boot. This boot from liabilities will be treated as any other boot in our calculations of figuring out what the recognized gain or loss will be. So in step 1 of our example, the realized gain is $110,000. The $120,000 amount realized minus the land basis. And since we've calculated boot to be $10,000, which is the $20,000 of debt transferred to the corporation, less the land basis of $10,000, that $10,000 of boot causes $10,000 of recognized gain, and the remaining gain, which is deferred, is $100,000. If we were to go on to step 3 to determine the character of this $10,000 of gain, that would depend on what the character of the land was to the shareholder before she contributed it to the corporation. The character could be ordinary, it could be Section 1231 gain, or it could be capital gain. Let's take a look at our other two calculations, the calculation of the stock basis to the shareholder and the calculation of the land basis to the corporation. Let's start with the stock basis and follow our formula. We're going to start with the carryover basis of the land. We're going to add any gain recognized. We're going to minus any boot. And we're going to minus any liabilities transferred that haven't already been counted as boot. That's the remaining $10,000. So the stock basis, in this case, turns out to be 0. Now let's calculate the land basis to the corporation. We'll start with the carryover basis of the land of $10,000. Then we'll add the gain recognized of $10,000 to give us a total basis to the land of $20,000. Let's double check the stock basis that we calculated by pretending that the shareholder now sells the stock and sells it for its fair market value. The fair market value is $100,000 that we've estimated. So let's assume that the shareholder sells the stock to Random Guy for $100,000 cash. Now let's calculate what the recognized gain would be on this hypothetical transaction. Remember, the deferred gain that we're trying to account for is $100,000 that we calculated previously. And remember that the fair market value of the stock is $100,000. Also remember that we just calculated the stock basis to be 0. So in this hypothetical sale, the realized gain is $100,000 and the recognized gain is also $100,000 because there is no code section to prevent the recognition of the gain on the sale of stock. And that $100,000 of recognized gain is exactly equal to the $100,000 of deferred gain. But let's change our example, and this time let's assume our shareholder has a sinister tax avoidance motive and that the IRS can establish this tax avoidance motive. Okay, that's a little dramatic. But let's assume that the shareholder, when they formed the corporation, had no legitimate business reason to transfer that $20,000 mortgage to the corporation. They only transferred it for tax avoidance purposes, and the IRS was able to show that. In this case, when we calculate the realized gain and recognized gain, the realized gain is exactly the same. However, the boot now becomes the entire amount of liabilities, $20,000. Therefore, the recognized gain is $20,000, and the deferred gain is $90,000. Let's follow everything through with our two important equations, the stock basis and the basis of the land to the corporation. Let's start with calculating the stock basis under these new conditions. We're going to take the carryover basis of the land. We're going to add the new gain recognized. We're going to minus the boot received and any liabilities that weren't already counted as boot, which now is 0. That gives us a stock basis of $10,000. Now let's calculate the basis of the land to the corporation. Again, we'll start with the carryover basis of the land, which is $10,000, and we'll add the gain recognized of $20,000 to give us a basis of land to the corporation of $30,000. To double check our calculations, let's now pretend that the shareholder sells the new stock with the $10,000 tax basis to Random Guy for $100,000, the stock's fair market value. The shareholder's realized gain would be $90,000, $100,000 of cash minus our basis of stock of $10,000 for a $90,000 realized gain. And since there is no other code section that would prevent the recognition of gain on the sale of stock, in this hypothetical transaction, the recognized gain would also be $90,000. And remember our deferred gain when we incorporated? It was $90,000. So the recognized gain of the stock sale matches the deferred gain on the incorporation. Thanks for watching, and if you liked the video and would like to see more, feel free to subscribe.